Good morning and welcome to our topic 7, all about accounting for income taxes. This is part 1 of the video lecture. We have 3 major contents of this topic. We have taxable profit versus accounting profit. Then later on we will discuss about balance sheet approach to accounting for taxation, carrying amount versus tax base. Expenses that may not be necessarily recognized under taxable profit on a particular period. And because of this difference between the rules between taxation and accounting, it creates what we call timing difference between revenue and expenses. Here are some examples of the difference between the generally accepted accounting rule and tax rule. So let's cite a few items here. We have doubtful debts. As per accounting rule, it is actually expense, but under tax rule, it can only be claimed as tax deduction when there is an actual write-off. So which means there will be difference between accounting profit against tax profit because of the recognition whether an item is deductible or not. Another example here is the goodwill impairment and entertainment. Under accounting rule, goodwill impairment and entertainment are treated as expense, so which means it will reduce the accounting profit. But under tax rule, it doesn't mean that you have to deduct item when it is expense as per accounting rule. Again, there will be difference between tax rule and accounting rule. Now, as per IAS, we will use what we call balance sheet method, wherein we are comparing the carrying amount of assets and liabilities, or carrying value of assets and liabilities, against tax base. So the difference will result to what we call differences or timing differences. Again, depending on the rule, profits can be higher than, or accounting profits can be higher than tax profit, or vice versa. Now, the timing difference or the temporary difference will be the result of the difference between carrying amount and tax base. So per IAS 12, the definition of carrying amount is the amount the asset or liability is recorded at the accounting records, while tax base is defined as the amount that is attributed to an asset or liability for tax purposes. Or plainly, when we talk about carrying amount, that will be the amount that we already knew when we studied accounting. And then tax base will be based on the amount that will be recognized under tax rules. Now, income tax expense is the result of multiplying accounting profit against the tax rate, while income tax payable will be calculated or can be determined by multiplying taxable profit against the applicable rate under tax rule. Now, this is the sample format of calculating income tax payable when you're starting from accounting profit. So, what you will do, determine the accounting profit, and then add expenses that never deductible for tax, and then deduct revenue never assessable for tax, and then less expenses for tax purposes. Then you can determine taxable profit. So taxable profit multiplied by tax rate will result to income tax payable. To journalize the income tax expense that you recognize, so debit income tax expense and then credit income tax payable. Let's try sample exercise here. We have situations 1 and 2. The first situation we have accounting profit, and the second situation we have accounting loss. And then these are items that had been recognized in determining accounting profit, so which means goodwill impairment, entertainment costs, donation to political party, depreciation of plant, and long service leave expense had been deducted in determining accounting profit. Okay, so you can see those asterisks there. It means that these are items that are not deductible for tax purposes. Now, for tax purposes, depreciation rate allowed by tax rules, instead of 10% under accounting rule, we have 20%. So which means, as per depreciation, tax depreciation rate, in situation 1, that 8,000 will be doubled by 2, so meaning 16,000 kina. For situation 2, that will be 8,000 kina. Okay. So let's try to see the solution. For case 1, we'll start on accounting profit based on income tax, 80,000. And then we will add those items that are actually non-deductible as per tax rule, as you can see in the previous slide. So we have the total of 23,200 kina there. And then we will deduct depreciation as per tax rule, which is 16,000. Then we will have taxable income. We will see that we can determine the difference and then multiply it by tax rate. We have 26,160 kina. So journal entry, debit income tax expense, and then credit income tax payable. For case number 2, we have a loss of 20,000 kina, and then just the same, we have to add back those items which are non-deductible under tax rule, and then deduct those items that are allowed to be deducted under tax rule. And then we have negative 10,400, or a loss of 10,400, and then multiply by tax rate. We have an income tax expense or income tax income in some of the chart of accounts. So the journal entry will be deferred tax as debit, 3,120, and then income tax expense, 3,120. And that ends our presentation for this recorded session, and see you on the next presentation.